Welcome to the BMO Capital Markets Real Estate Series on Markets Plus. I'm Warren Esty, Head of Investment Banking at BMO Capital Markets. This is where we bring together leading voices from across BMO to break down the trends, strategies, and market forces shaping real estate across North America. Whether you're an investor, developer, or industry leader, we're here to give you the insights that matter, so you can make confident decisions in a rapidly evolving landscape. Let's get started.
Welcome. We appreciate everyone taking the time to give this podcast a listen. This is actually the inaugural BMO Capital Markets Real Estate Series on Markets Plus, bringing you insights and perspectives on the trends shaping the North American real estate market. Really pivotal time in the market, both broadly and within real estate. And if the first half of the 2020s have taught us anything, is that change is constant and markets are dynamic. We've had a pandemic that we've lived through, and I would say the pandemic has really created a lot of unintended consequences. It front-loaded a lot of demand in areas like industrial and apartments. On the back of that, we had persistent inflation, which forced central banks to act. That action ultimately led to increased borrowing costs. And we went to a place where the market was sitting there and trying to come up with a theme, which ultimately centered on the concept of survive until 2025. The other big trend was Ozempic. And I think the transaction market went on Ozempic the last few years. It's been a little bit of Groundhog Day, where we're sitting there at the beginning of the year, 22, 23, 24. This is the year. There's a lot of dry powder. There's a lot of debt capital market, constructivity. And ultimately, the transactions hadn't played out. And so we live in a situation where large transactions are off about 70% from prior to the last few years. Flipping the script to 2026, really bifurcated market. You have challenging operating fundamentals in many sectors. More recently, you have questions on consumer confidence. We actually saw the U.S. Fed, so one of the larger central banks, pause last week on its loosening of interest rates. At the same time, we've seen something that, I don't know that we'll see again in all of our lifetimes, which is just massive capital flows into data centers and the build out of hyperscale and AI. It's been quite humbling. The other big trend is, again, in this bifurcated market, a lot of asset classes trading off and not really transacting. Senior housing, all the baby boomers and the population hitting 80 every day is really coming to the fore, and we're seeing a really big tick up in senior housing transactions. So with that, I think that frames where we are in the market. I think the positives to look out for, and we'll talk about this in the next few questions, is REIT balance sheets really are in a position of strength. There still continues to be significant private equity dry powder. And so for the next 20 minutes, I'd like to explore with my colleagues here, what is the fix in 26, or is there a fix in 26? Where's fundamentals going? Where's transaction volume going? And so I'm Stephan Richford, Managing Director, North American Group Head, Real Estate Investment Banking. I'm delighted to welcome and thank two of my BMO partners, industry leaders. First, Michael Brodie, Managing Director and Canadian Group Head, Real Estate Investment Banking, and Catherine Sierakowski, Managing Director and North American Group Head, Real Estate Corporate Banking. So before we dive into 26, guys, I think a big thing that it would be good, as we're all getting a little bit older here, is let's test our memories and take a quick look back. How did 25 play out compared to expectations? Michael, I'd like to kick off with you and give the Canadian lens.
Thanks, Steve. Certainly 2025 played out very differently than its survive to 25 moniker in Canada. Recall heading into the year, we'd gone through the fall of 2024 head fake in the markets, and we started 2025 off trading at almost a 20% discount to consensus NAV. So 2025 quickly turned into the year of the management buyout. Managers with large ownership interests in their REITs took action to unstick investments that were no longer working. So we kicked off the year advising on the Melcor Developments take private of its sister REIT, followed by the InterRent privatization by CLV and GIC, the RFA Artis merger in the fall followed, and then we'll throw in the recently announced Minto REIT privatization into this theme. In addition, in 2025, the great deleveraging cycle of the Canadian real estate industry in general continued. We've seen select asset recycling and a broad wind down of development initiatives help support right sizing of balance sheets in what is a higher for longer interest rate environment. With all that said, we ended the year in a much healthier position. NAV discount stood at a 10% discount to consensus NAV at the beginning of 2026. balance sheets crested below the 9x debt to EBITDA number for the broader public sector, and a general renewed focus on positive cash flow and cash flow growth has the sector headed in a more positive trend for 2026. It's already up over 5% in the first month of the year, and better days are ahead.
Thanks, Michael. Certainly a great start to 26 for the Canadian market. From the US side, I would say, look, as I sat here last year, January, February, I wouldn't call it Goldilocks. It wasn't in perfect balance, but there was an optimistic vibe and a tone due to lower interest rates, low unemployment. And I would say, as I talk about fundamentals on the kickoff tale of two markets, a view that supply demand fundamentals would become more imbalanced during the year. Listed REITs were still, on the sideline with the challenge cost of capital. Non-listed REITs were a big driver of M&A for quite a few years. We're still muted on capital flows. But the big pivot at this time last year was around pension fund and sovereign wealth fund optimism around deploying capital into equity after being debt investors for 2 to 3 years. And I would say, look, the big shock, we talked about political shocks at the beginning, was Liberation Day. We actually, in the US, were very fortunate to price a $900+ million IPO for Smart Stop self-storage REIT, literally on Liberation Day. Probably don't price that if we wait an hour. We also, the flip side of that is we're pulling bids for a $1.5 billion sell side the week after Liberation Day. And we had one of the largest global pension funds literally pull out because of Liberation Day. And as I mentioned on the top, that's led to a 70% reduction in large transactions last year. And so when I think about overall 2025, ton of potential, a lot of optimism, ultimately didn't deliver all it could have, but that's what gives me some optimism going into 26. Catherine, love to get your views.
Thank you so much, Steve and Michael. It is great to be here today to chat real estate. I think you both really hit on the key themes from 2025, all of which were supported by very constructive debt markets. While we did not see the volume of transactions we anticipated, as both of you mentioned, I think US and Canada, the transactions that did get done were quite well received by the market, and borrowers were able to access both the private and public debt markets with pretty solid execution. I would say you could even go so far as to look at the debt markets recovered more quickly than expected. I mean, we look at lenders across all types, banks, insurers, private credit, everyone expanded their loan origination activity at double-digit rates. And not only that, but some are pretty increasingly complex. There were a lot of complex transactions for sponsors, successful refinancings for many of our corporate facilities across the REIT sectors in both the US and Canada. And I will add on, I know, Steve, you mentioned this, but we saw two asset classes pretty active in 2025. Certainly data centers had a lot going on. And I would also say that healthcare really has been picking up steam, I would say last half of 2025 and even going into 2026 for both of these asset classes. And as you guys know, we've got a really solid presence at BMO in both those spaces. We announced our Sonida Senior Living deal where we're acting as joint book runner and admin agent. And we remain really active in the data center space, leveraging the cross-border expertise that everyone can see here with this conversation, as well as our balance sheet sophistication and trying to lead with strategic ideas. So I would say 2025, exciting, and look forward to 2026.
Cool. Thanks, Catherine. Really great, awesome commentary on 2025. Let's flip the page and move to 2026. So the question is, what major themes do you expect to define the real estate market the year ahead? Michael, kick off with you again.
Yeah, thanks, Steve. I think for 2026, we're going to see a lot more balance in terms of themes. We're not out of the woods yet, but signs are pointing to this is the beginning of the end of this cycle as opposed to an end of the beginning. On the positive side, we expect fund flows to become much more robust and positive for both public and private real estate activity, driven really by attractive valuations in the private and public sectors and the renewed focus of domestic institutional pension fund deployment of capital into alternatives. We also see healthier balance sheets and mid-single-digit AFFO per unit growth for the public sector, a very constructive debt market, particularly on the public bond side, where spreads are significantly more attractive than other forms of debt in the mortgage or bank market, and a return of core capital, which should start to bridge the bid-ask spread that has persisted for the past 4 years. What we'll watch for The Canadian economy, particularly in the near term, with implications from tariffs and a tumultuous global market backdrop, slowing to flat population growth and its impact on fundamentals, and the stickiness of the yield curve, particularly at the long end, which will continue to pressure investor return expectations. So I think with that backdrop, we expect to see a more active transaction market, a more constructive capital markets for public REITs, with capital raising occurring on a select basis, and strategic alternative activity to surface value for investors, which is continued M&A, strategic partnerships, maybe some more management buyouts and privatizations.
Thanks, Michael. Love that you were on there. I'm going to switch gears a little bit on 2026 in my commentary. And the reason I say that is I think from a U.S. perspective, and I see this a lot in the media, the narrative has really been focused on interest rates and central bank behavior. This makes some sense. Obviously, we saw the U.S. Fed pause last week. You have REIT maturities at $30 billion for the next 5 years after being $20 billion the last 2 years. CMBS maturities combined the next 2 years at $1 trillion. I don't want to make light of that. There is going to be increased borrowing costs as this debt refis. But absent some type of external negative shock or market shock, the math suggests that it's eminently financeable. As Catherine was talking about, a lot of lenders and providers are being very accommodative with borrowers. Terms are out there across all asset classes. And so that feels really good. So my major theme for 26 is actually a little bit different than the prevailing market theme, which is fundamentals. And I think the reality is what's holding back the market is the underwriting math. The bid-ask spread is compressing, but it's been wide for too long. And that's why you haven't seen this wall of demand for new assets really take shape. And so when I think about that, that is ultimately what's going to determine the trajectory and type of transaction volume we see in the market, and obviously operating performance. And again, I think you see this in the tale of two markets I was talking about in data centers and senior housing. You had a $40 billion now sale of the line data centers. And I would say, look, data centers are a little bit surreal. You have a meeting with like a REIT bellwether CEO, and then the next day you're doing, an AI financing for like $38 billion, and it's larger than the enterprise value of that bellwether REIT. And so the numbers get a little mind-blowing. Catherine also mentioned the $1.8 billion announced acquisition by Sonida Healthcare, which we were one of the advisors on. And again, these themes where large transactions can get done, the bid-ask spread has to make sense, and the debt markets are functioning to support them. So that gives me a lot of optimism. Again, cautious, but optimism going into 26. Catherine, I'll kick it back to you.
Yeah, no, I completely agree with all of that. I think fundamentals have been what has gotten lenders excited and on board with the, I think, positive momentum we have going into 26 from 2025. I really think the debt markets are going to continue to be very constructive. I think we've seen several examples of lenders stepping up, especially on the banking side, and focusing on their most important relationships and willing to stretch to go beyond, what one would call a typical lending box at certain banks. People are stepping up for their best names, and I think that will continue into 2026. And that will lead to continued increase in lender competition. Not my favorite thing to share, but really, I think a lot of us are focused on some of these best names with strong fundamentals, solid balance sheets, and, in the REIT space in both the US and Canada, potential future capital markets activity, which we all know is really important to get banks where they need to be from a return perspective. So I think picking their spots is where lenders are going to be. And I know where BMO will be stepping up for our best names. I do think, though, there's a lot of capital to deploy. And so that is going to lead to continued competition over the same deals, which certainly is another factor in driving a more favorable environment for borrowers. But I do think, as you said, Steve, there will be some hopefully stabilization in that supply demand, more transactions hitting, people getting deals to pencil. And hopefully, as we go into the coming years, given the lack of new starts in construction, this should help stabilize some new supply and helping us with leasing and improving trends there to get things more stable over time. And as you said, certainly outside of data centers, which is its own animal in a different realm of dollars and deployment, but I think that will continue as well on quite a large scale for the foreseeable future.
Right. Now, switching gears a little bit, but staying in the same theme, 2026, how do you think macroeconomic factors like interest rates and capital flows influence your outlook for 26? Michael, why don't you kick us off again?
For Canada, interest rates remain a key focus on how this cycle unfolds in 2026. Historically, rapidly declining short end of the curve hasn't always translated into material moves at the long end. And so what a higher for longer end of the curve does is it continues to pressure public companies' ability to generate positive cash flow growth through refinancings. It maintains a higher return requirement for private capital, and it makes real estate less competitive with alternative yield-oriented investments. We're expecting long-term rates to drift slightly lower through 2026, but generally stay in a fairly tight range. In the past couple of years, private equity capital has been pretty cautious, not just because of higher rates, but also the wider bid-ask spread and broader economic uncertainty in Canada. A lot of groups have essentially taken a wait-and-see approach. So if rates remain stable this year, along with some more certainty on the path for the Canadian economy and real estate fundamentals, we could start to see more real estate-focused private market activity and potentially some renewed interest in the public sector.
Thanks, Michael. Look, I think I covered interest rates in my last comment, which was, it's about fundamentals. I think capital flows. Let's take this in two pieces. One is the public markets. If you look at the listed REITs on over any time period, capital flows are almost the primary determinant of REIT share prices outside of something specific like data centers or senior housing right now, where the fundamentals just force people to pay attention. And I think in the public market, what you've seen is generalist investors are really the investors that are setting the REIT share prices. And if you look, going back to 2019, the S&P 500 has outperformed the RMZ by 8 times. The NASDAQ has outperformed the RMZ by 11.5 times over that same period. So generalist investors, frankly, have been getting better growth away from REITs. And so I think until that, stops or doesn't continue, and you see a slowdown in tech or other things, generalist investors are going to continue to park their money there. So I think that's number one. Number two, I already talked about non-REIT capital flows. That's still on the sidelines. We are hearing from some of the larger sponsors that there's a path to getting back to positive monthly subscriptions. And I think that would be a really nice benefit for the market. Again, given how prolific they were in the M&A market for quite a few years. Switching to the private market, look, we talked about this a little bit, record high dry powder. I think what's happening though is new private capital formation is down about 40% from the 2021 peak. A lot of commitments out to these mega funds. And I think that's what you're seeing is the LPs have been very patient. But if I was a small, mid-sized private equity fund and I had not a completely or totally differentiated product, I think you're going to see a lot of LPs really push to get some capital recycled so they can get some capital out into new investments as the market picks up. And so, look, real estate private equity was 80% of large transactions in 2025. I think that'll be the case. Similar to what Michael said, I think if REIT share prices don't rebound, that wall of capital constructed debt markets, you could see a really big take private wave. I think that dynamic is going to continue for the foreseeable future. Catherine, love to get your views from the debt markets.
Yeah, I think all great insights and feedback. I'll say on the US side, I think especially in terms of interest rates and factors here, policy related uncertainty is going to continue to be a risk. I don't think that's changing, at least for the rest of 26. If inflation does not moderate as hoped, timing of cuts could be less predictable. And are cuts really going to drive that much change at this point in the real estate values in the market? This could certainly lead us to a similar outcome to 25, with perhaps less transaction activity than we thought. And again, that continued increased competition amongst lenders. Certainly need enough deals to be feeding everyone on both the equity and debt capital side. As you mentioned, there's dry powder on the equity side that's ready to be deployed and has been, but there certainly is on the debt side as well, and lenders want to put dollars out. I would say on the Canadian side, as Michael mentioned, I think that rates are expected to remain in a pretty tight range, which can be really helpful from penciling things out on an underwriting and modeling perspective and help facilitate some of that transaction activity. But that being said, more volatility or any material increase in rates could lead to a negative impact there. But overall, across both countries, I think we have that kind of uncertainty, but optimism that things will start to hit more, and that even with some change in rates, deals are still going to be able to get done, given a lot of those positive fundamental factors.
Great. Thanks again, Catherine. And look, how do you see the difference between the U.S. and Canadian debt financing markets heading into 2026?
Yeah, that's a great question. I would say that the main difference just overall in the two markets when we look at it is the liquidity and the range of capital sources. In the US, again, you've got really active debt markets, banks, insurance companies, private credit. Everybody's increasing volume. Debt funds have raised significant amounts of capital, competing right there with banks, and spreads are tight, competitive lending environment. In Canada, you certainly have some of this, but it's more concentrated. It's a bank-led lending structure, which is just an overall, I would say, slower liquidity cycle. And I would say the Canadian side doesn't have quite the extensive structured capital solutions than compared to the US side. And that's just given the US is just a much larger market. I would also say another distinction is just the level of participation from the large institutions. I think US commercial real estate, again, being such a large global attraction for cross-border inflows, gets you a broader range of those risk return opportunities for any debt investors. And I think with these factors, the US is certainly positioned for a more transaction-friendly environment, and Canada will still have that stability, but perhaps at a slightly slower pace. But that being said, I think we've seen several large US sponsors and globally have been really focused on Canada, given, between the US and Canada, that base rate advantage that's been going on with interest rates. So I think people are really putting their pencils to the paper to try and get deals done and capitalize on that, which is exciting for us at BMO, especially given the fluidity of our real estate team and ability to really analyze and dive into both markets.
Great. Thanks, Catherine. All great points. And speaking to the breadth and the size and scope of the U.S. market, before data centers were eating the world, it was private credit. So really great points there. Let's close today with a final question. What advice would you give clients as they think about capital structure optimization, and what innovative solutions are clients utilizing in this environment? Michael, we'll keep the string going and kick off with you.
Thanks, Steve. Given the uncertainty of the political, financial, and macroeconomic environment, we still preach risk management practices. This can be a volatile time for aggressive actions if you are managing institutional or public capital. Balance sheet management and strength in the near term will always pay off as the cycle unfolds. That's been a consistent theme for Canadian REITs through 2025, and really since early 2022 when interest rates started to rise. Canadian REITs with lower and improving leverage profiles will generally outperform the more highly levered names, and that has particularly been the case since the start of this rate cycle. Creative deal structures and initiatives should continue to be explored by companies, particularly ones that are capital light, to grow cash flows. This can be JV partnerships, structured investments, and other approaches that will allow you to stay on offense without compromising your financial flexibility. We also think the benefit of scale in this market will continue to win out as we see consolidation and movement of investor capital into the more liquid, sizable entities.
Thanks, Michael. Yeah, from a U.S. perspective, I think we beat this up ad nauseum earlier in the podcast, but REITs have been very disciplined in protecting their balance sheets. I think the one thing that is pretty clear is, as a real estate investor, basis and capital allocation are the two primary determinants of success outside of being a great operator. So when we think about REITs on the public side, we've talked about capital recycling, been a great source of capital, certainly the cheapest cost of capital to grow or delever, use JVs to bolster balance sheets or support growth. REIT buyback activity has been very accretive in many sectors, peaked in 2022, but we're seeing a big jump in usage of buybacks as well as new programs launched. So I think that's pretty healthy in an astute use of capital. And then turning to sort of more new innovative things that we're seeing REITs test out foreign markets for the cheapest, best access to capital. A great example of that was BMO, which we executed 2 Maple bonds for SmartStop since June of 2025 for $700 million. There's been another big industrial REIT that's done the same thing in Canada. And I think the pipeline is generally growing given the cost savings there on the base rates. And spreads remain pretty tight in Canada vis-a-vis the US. We've also seen some structured capital, and what I mean by that is convertible activity, 2 US REIT transactions to start the year. Both went very well, and I would say from a run rate perspective on a current basis, the cost savings to most investment grade REITs is in that 100 to 150 bips range. So again, this thesis of going to the cheapest cost of capital And the last thing I would say on the listed REIT sector before I flip to the private side is REIT activism. We just don't see slowing down. So I think being really attuned to your strategy, capital allocation, capital structure is going to continue to be paramount to success. And we think ultimately that'll drive things like pipes, structured products, M&A, take privates. So I think that could really push a lot more activity in 2026. Again, we've seen it take private within the last week with Peakstone announced sale to Brookfield. So again, that should continue to be a trend. We've already touched on earlier, a few minutes ago, on this dynamic between large PE and mid-sized PE. And again, LPs have been very patient. But I think when we look at allocations, a lot of these LPs are under allocated, and I think turning that capital is going to be they're going to be less impatient in 2026. And my thesis there is that when you look at dry powder from private equity and you look at REIT balance sheets, certainly a great opportunity for them to take advantage of a market where LPs are seeking liquidity. We would be pretty optimistic on the ability to capitalize that in 2026.
I agree with everything both of you said. I think clients should view 2026 as a period for strategic flexibility on the financing side. Consider the broader capital stack. Structured capital can serve not only as a defensive measure, but as a tool to enhance flexibility. Preferred equity, hybrid capital, structured credit can support deleveraging, recapitalization, or selective acquisitions without taking on excessive risks. And maintain clarity in how you want to position things. Capital providers were selective, so it's important to clearly communicate your strengths, such as operational capabilities, your performance history in challenging markets, and any differentiated business strategies. And finally, please take note of the current favorable debt market conditions. I think we've really emphasized this today. With tight spreads and strong origination activity goals, proactively refinancing or adjusting capital structures could provide additional stability as the market dynamics continue to evolve. Key to any successful bank deal continues to be pre-marketing and maintaining relationships with your largest bank counterparties. One deal I'll highlight from this past year that exemplifies this is where BMO served as left lead arranger and admin agent on the recast of GNL's $1.8 billion revolving credit facility in the U.S. The credit facility recast was then dovetailed by a BMO-led ratings advisory process that resulted in an inaugural IG rating by Fitch. The pre-market prep, the communication of the need and relationship with lenders, as well as the timing, led to a successful recast and eventual IG rating, which is a win-win for the company. Overall, I'd say the market is seeing tremendous innovation in how clients structure capital and execute transactions. And the better you can communicate your differentiated business strategy, go forward plan, the more creative your bankers and hopefully BMO can be to help you find the right capital and growth solutions.
Thanks, Catherine. Great points. Just to close it out here, thank you to our sponsor, BMO Capital Markets, and my partners, Michael and Catherine. Great insights today. Not sure if we solved the fix for 26, but certainly a number of reasons for cautious optimism going into the year, given the strength of REIT balance sheets, the constructive debt capital markets backdrop, including tight spreads and ability to support large transactions, private equity dry powder, and LP seeking to recycle capital. For more perspectives on real estate and capital markets, stay tuned to Markets Plus. Thank you for your time today.
Thanks for listening. You can follow this podcast on Apple Podcasts, Spotify, or your favorite podcast app. For more episodes, visit bmocm.com/marketsplus.
The views expressed here are those of the participants and may not necessarily represent those of BMO Capital Markets, its affiliates, or subsidiaries.
For BMO disclosures, please visit bmocm.com/podcast/disclaimer.